Friends, the topic of today's podcast is vexing volatility. In bull markets, when stocks keep going up every day, many of us tend to get vexed that we are not able to buy anything. Not being able to invest can also be vexatious. Today we have come far from those times. But it hasn't been long. Barely in under 18 months, we have moved from one end of the spectrum when we could get easily vexed because we could not invest. We are at the other end of the spectrum where we are vexed simply because we either cannot sell or stocks are so low. Becoming vexed is a choice. It is something we choose to be. It was very much possible for us to sell stocks which we did not really care too much for in those great days. Instead, we chose to become vexed that we could not invest. Now, the field is wide open. We can invest as much money as we want in equities, and yet we are vexed. The most important thing that we need to understand in this is that every investor must learn to treat volatility as his friend. If markets are volatile, use it constructively. Buy what you have been wanting to buy for a very long time, but did not because valuations were high. If you are a mutual fund investor, what should you be doing? What you need to do is invest in stable parts of the market which deliver consistent returns over 3 to 5 years. You need not buy or pick a theme like a small cap. Instead, you can invest in relatively more stable parts of the market where funds invest in larger companies which enjoy much more business stability. It could be an index, it could be large cap, it could be diversified. But the important thing is that when markets are volatile, you must use this volatility to put in more money. This is not the time for us to be vexed that you invest today and shares are lower tomorrow. I see a lot of people getting this thought out of frustration. That is, why not I sell everything today and then buy later when stocks fall further? To me, that is a counterintuitive signal of a potential bottom in the near term. Because when people think it is so easy to sell and buy, rather than buy and sell, it means that they are not reacting to the fundamentals. They are only reacting to the technicals and the volatility. They are unable to bear it. And that really spells a great opportunity. Many of the scripts that have fallen now have not fallen because of some change in the company's fundamentals. The reasons for their fall are more macro and sentiment driven. While I do concede readily that that sentiment is not going to reverse dramatically in short bursts of time, it is important to remember that when sentiment is very negative and that negativity far exceeds the reasons which are valid, an investor must condition himself to use that negativity constructively. Let us remember that we were unable to use our positivity constructively in bull markets. But in bear markets, your positivity can be used constructively. And your positivity comes from the negativity of the rest of the market. So stay away from the herd. Don't get vexed that markets are volatile. with more volatility, find more money to invest. Anyway, your interest rates are very low and going into debt is not going to give you good returns. So make the most of this volatile phase for the market to right size your equity exposure, to increase your equity in your overall asset allocation and gradually build an investment book that will deliver outlier returns over the next 3 to 4 years. Thank you very much. Happy investing.